Welcome to the Quarterly Market Outlook. I'm Rusty Vanneman, President and Chief Investment Officer for CLS Investments.
And I'm Case Eichenberger, CLS Senior Client Portfolio Manager.
Case, it was a crazy and wild fourth quarter to last year. Tell us about it.
It was. I wrote about this today. So the fourth quarter was one of the worst in a long time. The month of December was one of the worst Decembers since the Depression, if you want to go back that far, which means we've had a lot of really good Decembers leading up to this, of course. So, but most equity markets really in the negative. Really what helped though is your global diversified portfolios. So bonds, why would I hold bonds in 2017 and when stocks are ripping? But you really wanted bonds here in the fourth quarter and the month of December.
They had gains.
They had gains. The aggregate bond index eked out a gain mainly due to the month of December's performance, so that was great. And then international stocks really, they were down, of course, and other diversifiers like commodities and real estate were down, but they were down much less than broad U.S. stocks. So if you're just holding U.S. stocks alone, you really got hit. But if you're multi-asset like we are, you benefited. You did okay, relatively speaking.
So again, just to kind of wrap it up, in absolute terms, it was a tough quarter, even for globally diversified portfolios. But globally diversified portfolios held up a lot better.
Exactly.
On a relative basis. Great. Well, great. Well, in this quarterly market outlook, what we're going to do is we're going to review performance over the last quarter, also our outlook. I'm also going to sit down with a few members of the PM team, and we're going to talk about how balanced portfolios have behaved. We're going to talk about volatility, and we're going to talk about the CLS investment themes. Let's review the markets from last year. First of all, it was not a great year for the markets. It was the worst year for the financial markets since 2008. However, if you look at it in a different way, in terms of how many asset classes were above 5%, it was arguably the worst year ever for diversified portfolios. There were 5 reasons for losses last year. First, valuations are rich. Second, we are seeing decelerating corporate earnings growth. Third is that there are higher interest rates. The fourth reason is that we have extreme political uncertainty, which is uncharacteristic of this stage of the presidential cycle. The fifth reason is negative price volatility actually feeds on itself. Good news, however, the outlook for 2019 is much brighter. Stock markets typically move higher after corrections like we have just seen. Let's break down the market returns from last quarter. First, the overall global stock market lost nearly 13%. When we break that down, first, the U.S. stock market lost more than 14%. And within the U.S., larger U.S.-based companies lost more than 13%, while smaller companies lost more than 20% last quarter. International markets, meanwhile, fared much better, but were also down, as international stocks lost more than 11%. Breaking down international stocks into developed and emerging markets, first, developed international lost nearly 13%, while emerging markets outperformed as they were down more than 7%. The bond market gained nearly 2% last quarter and finished the year unchanged despite the fact that yields did go up last year. The bond market also beat the stock market for the first time in many years. The 10-year U.S. Treasury yield ended the year at 2.69%, and the 3-month Treasury bill ended at 2.45%. Elsewhere, real assets were mixed. Commodities lost more than 9% last quarter, while global real estate investment trusts lost more than 6%. Given this market backdrop, it's important to note that CLS portfolios performed well on a relative basis due to the positive performance of the bond market and the outperformance of emerging markets. Now let's bring in a few members of the PM team to talk about balanced portfolios, market volatility, and the CLS investment themes. All right, guys, we have a lot to talk about here today. You guys ready?
I'm ready. Heck
yeah.
All
right, so there you go. Heck yeah. So first of all, epic quarter for price action and volatility. And Kosh, you have written so much about volatility, including in the upcoming quarterly market outlook. Tell us about it.
Well, 2018 certainly feels like a volatile year, but it's all relative. It just seems that way because 2017 was so calm. Markets are generally volatile, that's the thing, and it was actually quite normal. The other funny thing about volatility is it goes both ways. What I mean by that is there's just as many up days as there are down days usually. It's just the human brain kind of focuses more on the down days.
You feel those down days.
Exactly, exactly. And we all feel them in our portfolios. Bigger impact when it drops.
Yeah.
So to kind of prove some of these points, we did some analysis. We ran a few charts. We looked at the S&P 500 back to 1928, looking daily price returns and how many days per year were there less than negative 1% and greater than positive 1%. Basically large down days and large up days. So in a little bit of trivia, 2017, how many were there? How many large down days were there?
Hardly any.
4.
Yep.
Only 4 days. But how many were there in 2018? There's quite a bit more. There was 32. But if you look at the historic median for such days, all the way back to 1928, the median is actually 25.
Yeah.
So 32 seems just slightly over the historic average. Certainly last year was the outlier.
And again, many investors think that it was way more than that.
Exactly.
Particularly because they just happened at the end of the year. Right.
And as I said, the large up days, in 2017, there were also 4. There was 8 for the whole year of large days. And in 2018, once again, 32 up days. So I said it goes both ways, right? There were just as many up days as there were large down days in 2018, kind of going to show that it really doesn't, it's really not as bad as it seems.
Yeah.
And then the historic average for large up days was actually 26. Remember I said it for the down days it was 25. I always like to find little data points that show that the market is not just a coin flip. That's always great to see.
That's right, absolutely. So again, I think the takeaway for investors is to think volatility, again, is just part of the markets. And the volatility spike we've seen recently is really normal behavior, and we should expect that sort of volatility moving forward. Generally, it's always just good advice to expect volatility moving forward. Well, related to that is, of course, the whole concept of balanced portfolios and sort of this perception that balanced portfolios have not performed well in recent years. Hey, Grant, what's your take on that?
Sure. So balanced portfolios is what we built here at CLS, trying to balance the risk and return of a portfolio. And we do that by utilizing a variety of different asset classes, right? Bringing those together. The standard 60-40 is what people kind of think of when they think of balanced portfolios.
60% stocks, 40% bonds.
60% stocks, 40%
Yep.
bonds, yes. But you can really expand that, and that can be U.S. and international stocks and things like that. So the last 10 years or so, you've seen 7 to 8% returns out of these kind of a globally balanced portfolio. Historically, it's been more like 6 to 7%. But a number of firms kind of going forward, ourselves included, think that those balanced portfolios will return about 4 to 5%. So lower returns, a lot of that has to do with lower expected returns for U.S. stocks and bonds. So in the piece, in the quarterly market outlook, you can see those firms and we list out those expected returns. What I think is important about that 4 to 5% is that 4 to 5% includes international stocks. So the expectations for a U.S.-only stock and bond portfolio is a lot lower than that.
Yeah.
The expectations for international and emerging market stocks are a lot higher in our expectations and other firms. And so bringing those together in a balanced portfolio is the best way to kind of have that forward expected return. One kind of other important aspect of a balanced portfolio is risk reduction and risk. Obviously, that's what we do here at CLS, is manage risk budgeted portfolios. But bringing together two asset classes that are uncorrelated with one another is always going to drop your return because of that lack of correlation. Or, sorry, drop the risk because of that lack of correlation on portfolios. And that's just mathematical principle of them not being correlated to one another. If they were perfectly correlated, you don't get a risk reduction. But if there's even slightly less correlated, you get that risk reduction. And that always works.
It's just math.
It is. Yeah. And I think going forward, cash is paying 2% now, may get up to 3%. And so you think 4 to 5%, well, that's not a huge benefit over cash. Well, that 1 to 2% over time is huge, and that adds up in the power of compounding returns. And of course, these returns can change in the future as well. I think in the quarterly market review, there's a great video from Warren Buffett as he talks about the power of compounding returns. I think that's always a really, really important message for investors. And you don't get that if you get out of the market. So.
Yeah. Well said. That was a lot of stuff there, and it was good stuff. So first of all, balanced portfolios have worked over the last 10
Right.
years. Even globally balanced portfolios, there may be a perception they haven't, but they have performed well by historical measures. Moving forward, however, that balanced portfolios probably will not perform quite as well. And about the only way to really sort of enhance returns is to mix in some international exposure as well.
Right.
So it's great. All right, so now let's talk about the CLS investment themes. And so they are staying the same this year, but let's review them anyway. I think there's three good themes. They describe a lot how our portfolios behave and kind of our outlook. The first theme is be active. Kosha, what does that mean? Be active.
Be active. So be active is a two-prong approach. First off, it means we like active managers. We like to invest in ETFs that are active. Basically, when the markets become more normalized, more volatile, there are larger opportunities for active managers to outperform. And that's kind of the scenario that we're going into. So we've been investing more in active managers, particularly on the fixed income side. In fact, about 20% of our portfolios are now active, whereas industry averages are about only 1 to 2%.
That's a really big number. I think it
Yes.
describes a lot about CLS portfolios. I mean, that really jumps out. The ETF industry is only 1 to 2% actively managed ETFs, and we're nearly 20%. That's a
Exactly.
big number.
The other prong is we are active ourselves. We're active managers, and we have tilts that we favor in certain market environments. Currently, the big ones are value stocks and international stocks. Valuations and many other analytic factors really favor those two areas of the markets to outperform going forward.
So a great point. So a couple things. So in terms of CLS performance last year, and in terms of the Be Active theme, first of all, our security selection, so the ETFs that we picked that were actively managed, added performance. They accrued value to our client portfolios. But our outlook on value and international has been early, has not been rewarded yet, so that has actually detracted a little bit of performance this year, though it's clearly helped over the last 4 months. So that's great.
Definitely.
Well, related to that theme, I can talk about this as Be Smart. I mean, all of us can talk about Be Smart, and this basically talks about we're using smart beta ETFs, which is basically rules-based active management. And some of the smart beta ETFs that we favor include value, which we already talked about, but we also like quality, which is an area that you like quite a bit. Momentum, low volatility, small caps, we use them all. And actually, they have also helped add value to us this year. In fact, our use of smart beta and actively managed ETFs have added value again to client portfolios this year, which has been great. Well, the third theme is Be Creative. And Grant, this is an area that you cover pretty closely. So what is the Be Creative theme?
Sure, I think be creative, and all the themes really go off that idea that returns are expected to be a bit lower, right? So utilizing active managers to kind of enhance returns, using smart beta and these proven factors to enhance returns. Be creative is no different. So in a couple different prongs there as well in the fixed income space, using active managers, but then also kind of being active around the fixed income markets, utilizing products, floating rate securities, treasury inflation protected securities, and things like that. Just diversifying our fixed income a bit more, being more creative than just a core solution there. But then also the use of real assets and liquid alternatives to portfolios. So use of commodities, which have had kind of mixed returns this year, helped a lot in the beginning of the year, and it's kind of given a little bit back. But strong correlation benefits there that we haven't seen in some time, which is positive for portfolios going forward. And then also liquid alternatives. So we have these alternative strategies, and those are kind of evolving and growing in the ETF space. And we've used those a lot in portfolios, and those have been helpful, especially in December. We saw a lot of the liquid alternatives we're using flat to slightly lower, which on a relative basis to stocks and other asset classes, that's been beneficial. So
Definitely.
Great. Well, it's great. So be smart. Well, actually, be active, be smart, and be creative. Sounds good. Well, thanks, guys.
thank you.
Absolutely.
So a lot of great information there, Rusty. Thank you for that. To recap for the quarter, it was a rough quarter, but globally diversified multi-asset portfolios definitely held in there and held their own against maybe just an all portfolio of U.S. stocks. So that was good to see. And then really going forward for 2019 and the years ahead, we expect a lot more positive returns, if you will.
Yeah. I definitely think the future is bright for globally diversified portfolios. Absolutely.
Great.
Well, for more information on our quarterly market outlook, please go to clsinvest.com and get the PDF. Thank you for your time and trust in CLS Investments, and we'll see you next quarter.